This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, and today I have a very special podcast for you, episode 2 in a new series, Exploring Payroll Connectivity. In today's episode, I talk with Matt Gomes, GM of Consumer Lending and Banking at Argyle, and Jonathan Katz, VP Client Development at Amount. In today's episode, we talk all about lending. We talk about how lenders are starting to use payroll data in lending, finding new opportunities to leverage this lower cost real-time access to payroll data, and how that unlocks a whole new set of opportunities that were previously out of reach. It was a great episode, and I hope you enjoyed as much as I did. Okay, so I'm very happy to be joined for this episode by Matt Gomes and Jonathan Katz. I want to do some quick introductions. So Matt, why don't you go first? Can you tell us a little bit about your role and your background in the industry?
Yeah, absolutely, Alex. Thanks so much for having me on the podcast. So Matt Gomes, I lead the consumer lending and banking lines of business here at Argyle. I've been with the company for going on a year at this point, but I'm actually a former client, so I've known the team for about 2.5 years. Liked the software enough that I left the lending space, and now I'm on the more tech side of fintech, but spent the prior kind of 7.5 years of my career in U.S. consumer lending, most recently in Opportunity Financial, and before that was at Avant. I also know a lot of the Amount folks as well.
Awesome. Perfect. Well, thank you for joining us. And that is a perfect segue to Jonathan Katz. Jonathan, can you give us a quick introduction to yourself and to Amount?
So John Katz, I'm the VP of Client Development here at Amount. So I've actually been with the company for just over a year, but came via acquisition of Linear Financial Technologies. So been in this space for about 6 years, helping banks and other financial institutions digitize their lending operations in small business and consumer. Prior to that, I spent over a decade on Wall Street as a bank analyst and investor. So, playing with in the banking space, knowing the teams, knowing the strategy, understanding the markets and the reactions accordingly. That's really where I spend most of my time. And then in terms of Amount, we help clients rapidly modernize and digitize with origination software for consumer, small business, and embedded finance lending. So really focused on banks ranging in size from, sort of your nationals, regionals, super regionals, and then, some smaller community banks as well. So looking forward to the conversation, and thanks so much for having me.
Absolutely. Well, let's jump into it. So, John, I want to start with you. I think before we get into the specifics around payroll connectivity and payroll data and what that's all going to look like, I'd just love to get your thoughts on just kind of a level set for where we are with lending. As you referenced, Amount does a tremendous amount of work helping banks and credit unions in the U.S. digitize their lending processes, their operations, and just sort of preparing themselves to compete in this new post-fintech environment that we're all adapting to. Can you sort of characterize what you see as some of the big priorities right now from banks as it relates to lending? Like, what are they focused on? What are the things that are top of the list right now?
I think customer experience, both for the branch and self-service, for both consumers and small business, that's really top of mind right now. I think the financial services industry is really, understanding that these consumers, or whether they be, consumer borrowers or, consumers who are small business owners, are really used to that sort of Apple and Amazon experience that they see in their everyday lives, and they want to see that in their financial lives as well. So banks are really trying to reach their customers how they want, where they want, when they want, right? Sort of that, to be a little bit cliche there. And I think that's taking shape in a bunch of different ways, whether that be, partnering with someone like us to help them create that end-to-end experience, using, platforms like ours and others as components of that. You're starting to see banks get really sort of innovative in terms of, creating their own enterprise layers for, customer interfaces across their whole enterprise. So I think that's where they're spending a lot of time, right? Aside from the sort of macro environment that everyone's dealing with now collectively. And I think what they really are thinking about even more, sort of deeper beyond sort of that high level customer experience is, how exactly do they reach their customers? And that goes a little bit deeper into beyond the sort of traditional lending, right? So like, customer walks into the branch, goes to the website, they apply for a credit product. What the banks are really looking to do is be part of that payments ecosystem, really be part of that embedded finance experience. That's really still emerging. That's really still being defined by the market, exactly what that will look like. But I think those are really the focuses right now, based on what we're seeing.
I think those are the two sort of right areas to focus on, right? Because on the one hand, there's just seemingly this recognition that the underlying processes at banks that drive the manufacturing of lending products, right? Realistically, like what it takes to actually manufacture a loan and get it into a customer's hands, that they're not well designed for a digital era, right? And so it does seem like, and I know Amount works on this every day with clients, sort of rebuilding the components that go into the manufacturing of loans so that they can fit within these new digital processes. But to your point, the other side of that is recognizing on the part of banks that, now that we have sort of modernized our manufacturing process, we also need to think about distribution differently. And, obviously banks have huge legacy infrastructure with branches and digital banking and advertising with lead aggregators and trying to drive volume themselves. But it does seem like sort of a large scale shift we're seeing is this move towards embedded finance and kind of just putting lending wherever it needs to go. So I do like the idea of sort of splitting up what banks are focused on into almost sort of the manufacturing side and the distribution side, both of which are changing pretty fast. Matt, I'm curious maybe if you can chime in with your perspective. I mean, obviously you come from a lending background before you joined Argyle, and now doing what you do, I know you work with a lot of companies like Amount to talk about what a good sort of modern lending strategy looks like. What, from your perspective, are banks focused on? What are they worried about?
It's a really great question, and it's important, before answering directly, to contextualize it a little bit. I think it depends heavily on where, a given financial institution typically operates in the credit spectrum. Would say, particularly in this environment, right? So you have rising delinquencies, pretty high inflation, past credit performance is not as good of a predictor for future credit performance as it is when things are a bit more normalized. I would say in general terms, financial institutions that are focused on the kind of prime plus segment. So I'm going to define that. Everyone defines it slightly differently. I'm going to define that as a 720, maybe a 725 FICO and up. Anyone who fits that general area of the landscape, they're really, really focused on how to intelligently manage risk. And by that, I mean how to not make broad credit cuts, because it really, really reduces the total addressable market that those financial institutions can, help and go after. And what I mean by that is, in an environment like this, you see a lot of folks say, that used to be willing to underwrite down to a 650, they tighten up to maybe a 700. And it's just a very quick way of updating their underwriting policy and doing something like that. That actually has a ripple effect. So if we ignore the prime plus corner of the market and talk about everybody else who's really serving that, near prime, maybe non-prime customer, there's this cascading waterfall where folks who used to qualify for that prime plus loan are moving a little bit down the FICO spectrum, but not from a credit score perspective, really from an institution who's willing to underwrite them perspective. And so folks that are really focused there, what they're trying to do right now, is counterintuitive as it seems, is just maximize efficiency, because they're seeing this huge surge in demand for folks that wouldn't have gone to them, who no longer qualify for maybe a lower cost product. And so, on the one hand, at the top of the market, you've got folks that are trying to come up with new, I think, more tailored ways of managing credit risk. And on the other hand, if you're focused on kind of that central pillar, maybe even down to the non-prime, they're really, really focused on how do we do things more efficiently. They don't have to quite worry about credit risk yet. That'll come a little later. Not to predict the future entirely, but having gone through it before, my expectation is that's, 6, maybe 12 months away, further down the FICO spectrum.
Yeah, no, it makes sense. Well, and predicting the future is what we do here. We mostly get it wrong on this podcast, but we do attempt to do that. So I appreciate that view. And I mean, I think it's really interesting, right? I mean, people who are listening to this can't see my hands as I'm doing this, but it's really talking about shifting that demand curve as the credit outlook changes, right? And so I think you're exactly right in that there is a segment of consumers that are used to maybe being able to work with different providers or just get a different experience, and they're now needing to get credit elsewhere. And, one thing that I think is a truism, but is very true about lending is that demand for credit doesn't go away, right? The conditions change, the availability of capital changes, risk appetites change, but, people need credit, businesses need credit, and that doesn't really change. So as that demand shifts around, I think it does have some really interesting ripple effects. I wanted to ask, Matt, maybe as a follow-up to you, in the last episode that we did, we were talking to Shmulik at Argyle. We talked about this transition that we've been going through over the last really 50 years in terms of where we look to get insights to drive those risk decisions that you're talking about. Historically, a lot of the data that we've used and a lot of the insights that we've fed into that process have really, for obvious reasons, come from the credit report. That was one of the first sort of programmatically available sources of insight into consumers' behavior that could drive lending decisions. And I think one thing that maybe is underappreciated about the history of that is that we've had decades, and it sounds like both of you have been working at banks that have done this in the past. We've spent decades basically squeezing as much sort of predictive value out of that data set as we can. And one of the things that came up in my conversation with Shmulik that I'd love to get your take on is some of the data that's contained within the credit report is really well suited to making certain types of decisions, right? When you're looking at what is a consumer's willingness to pay over a long period of time, well, there's good data in the credit bureau that can help sort of inform that decision. But I also think just because we haven't had access historically to a lot of other data, we've stretched the credit file in ways where maybe it wasn't always intended to be stretched that way, or it's not best suited to answer certain questions. And this is getting into things like verifying income and looking at the stability of a consumer's income, or just sort of other indicators of their sort of financial performance. And the reason this is all very relevant, and the sort of the purpose of this whole series that we're doing, is that the data sets that are now available to lenders are changing. And obviously we have open banking. We now have this sort of new world of payroll data. And I'm curious, Matt, if you can sort of characterize, specifically from a lending perspective, what are some of the gaps that have existed that maybe we've papered over a little bit in lending traditionally using more traditional sources of data that can be better addressed by payroll data?
It's the reason our industry exists, and it's the reason it's becoming more mature over time. So I'll start on the credit report and kind of credit bureau side. For as much valuable data as exists there, there's also kind of this inherent flaw in that model, in that credit bureaus, and therefore the scores calculated on the data stored at credit bureaus, it relies almost entirely on furnishers of that data as defined by FCRA and consumers actually to review their reports and catch errors. And so, I think it was as recently as last year, right, the FTC published a report that effectively said that 1 in 5 credit reports has a material error on it. So right off the bat, that's 20% of the US adult population where there is something materially wrong in the data set that would be used traditionally, right? And that's obviously a problem. The way I think about traditional credit reports is they tell a really interesting story, but it's a very narrow part of the overall picture for a given consumer, right? I think, to borrow your words, willingness to pay over time. It's really, really good at doing that. I think in the aggregate, it's pretty good at ranking risk. 9 times out of 10, a 750 is going to outperform a 650, right? If you're just looking at FICO. But there's also a lot in there, and again, I'm going to go back to the environment we're currently in, that's just flat out missed. And the example I always go to here is just credit card payments, the nature of how credit cards are structured. So let's say that someone, just a consumer A, has lost their job. They don't have a ton of savings, so less than half of the country can cover a $1,000 unexpected expense. But a lot of those people that can't cover the expense have access to credit cards. They could spend money today without having any source of income, because that's obviously not going to get reported to the institutions that extended the credit cards. For 30 days, they could be spending money. Then there's a 25-day period after the statement period closes before that payment is even due. After the 25-day period, there's a 5-day grace period. as required by the Card Act, which absolutely should exist. And then after that, there's another 30-day delay before the financial institution who holds the debt on that credit card reports it to the bureau. That means end to end, you could be looking at a 3-month gap in someone's ability to repay credit they could be applying for right now. And if I were lending still, that would terrify me, given the environment that we're in, right? You have slightly rising unemployment, not crazy spikes like what we saw in 08, 09 or anything like that. But certainly inflationary pressures on consumers are driving significantly higher card balances, even exceeding pre-pandemic levels, which I would not have bet on this quickly. And so, I think one of the really big gaps that employment and income data can solve for and payroll connectivity can solve for is confirming that someone is still able to meet even their existing obligations before you consider whether or not to extend additional credit. And I think another thing that you touched on, and this is something that's less applicable in my mind for a lot of salary workers, unless they're heavily commission based, but looking at something like income stability, right? And I think a direct comparison between, open banking and like the data sets that are available via Plaid, which is super, super valuable data, by the way. But one of the gaps there is it's generally very hard to get a full 365-day picture of what income looks like over time. I think a lot of lenders tend to use 45 days, maybe 90 days if they can get it, and impute what income is from that. And one of the beautiful things about payroll connectivity is that it can give you a complete look back for as long as that individual has been employed at that employer to help you normalize for some of the seasonal changes in income. Or, again, addressing something like, someone whose majority of their income is sourced via commission, right? So I think it tells a much more complete story by stitching together these different sources than relying on a credit score alone. And again, just thinking about the macro environment, I really, really think that kind of getting to that more complete picture. I wouldn't even say it's a complete picture with all the data sources we have today. There's going to be more that kind of come to the forefront in the coming years, but doing everything in a lender's power to get to that, as complete picture as possible is really kind of the key in my mind.
No, absolutely. Well, and I think, to go off the examples you gave, the real-time nature of the data is such a game changer, right? Because to your point about someone losing their job, we find ways to stretch in the credit bureau, credit score world to try to account for that, right? So like a thing people are often surprised by is, I didn't know that having a bunch of inquiries on my credit report over a short period of time hurts my credit score. Why would that be the case? And the answer, if you sort of untangle everything, is that that's really the only way to detect desperation of a consumer who might have lost their job or who has a need for credit, but the impact on the performance of their existing loans hasn't shown up yet. So it's this weird contortion of the credit bureau and the credit score to account for exactly that risk that you're mentioning. And the only way they could do it was looking at inquiries. And so it is interesting how much we've sort of bent the existing data sets and models almost out of shape from what they were supposed to do in order to account for these things that we just didn't have visibility into. So I think that's, a really good point.
And one thing I would add there, so you've jogged my memory, so that this kind of shift to digital and basically the financial system moving into the 21st century, if you will, great example of that is clusters of inquiries. Credit bureaus weren't prepared to handle that. So when you had the rise of the Credit Karmas and lending trees of the world, and you could say, hey, I want to see what loans I do qualify for so I can comparison shop and find the right product for myself. It took years for bureaus to kind of catch up and go, oh, actually, these 20 inquiries that happened within, 100 milliseconds of each other, that's really only one inquiry because that person's looking for one product. And so that, everyone introduced a slightly different metric and you can look at both to account for that. But you think about that digital shift, you're absolutely right. I think that only relying on credit bureau data it's becoming harder and harder is really what I'm trying to get at there.
I think that's exactly right. And I'm guessing we've all probably had this experience. I certainly have of I'm doing a kind of home improvement project in my house and the perfect tool would be this other thing, but I don't know where that is because it's in the garage and I lost it and it's gone. So I get the tool that could kind of do the job, but I don't know if you guys have done this, but I've definitely had the experience of like accidentally putting a hole in my wall or doing something because I was using the wrong tool, even though I knew better and I knew there was probably a better tool over there. So I do think this idea of like being able to right size the role of the different data sources and models to what they're really good at and giving just a bigger toolkit to lenders makes a lot of sense. And, John, I wanted to go to you on this actually, because at Amount, I know one of the things you guys do is basically work with lenders to say, where do we incorporate all of this great data? I mean, I know having been in the shoes of someone trying to sell data and other services to banks in the past, they're just inundated with everyone has like a better mousetrap and another like, I have this new data source, this new thing you need to try. Argyle obviously is one of those companies, out there kind of pitching their services. And I know that banks oftentimes feel overwhelmed about, okay, like, what does this do? How does it fit into the stack of things I'm already doing? Operationally, how do I incorporate it into my workflow? How do I think about like least cost routing and where this data fits in? So when you think about payroll data and you think about the conversations that you've had with banks and other lenders that are starting to think about this data, like where do they see it fitting in? How are they evaluating it? What gets them excited?
We've said a few times the shift to digital, right? So, the way I've described it, and this is not original by any means, right? This is actually a generational shift going from analog to digital for many large financial institutions and even mid-sized ones. Mm-hmm. What comes with that is they're still in a traditional mindset in terms of how to evaluate risk and how to underwrite risk. So what we've done is, with a sort of analytical mind frame and sort of an insights mindset, help them advance and say, okay, well, this is the way you do things when the world is manual and you underwrite a $5 million deal. That's a middle market deal that you may still do fairly manually, right? There's some judgment there, but you don't want to do that for the $50,000 consumer or small business deal. So we're helping them, understand what data sets are available, how to use those data sets to make a better decision, make a more efficient decision, but not take on any more risk, but maybe approve more customers without adding any risk, and really using a model that's been proprietary internally. Banks have leveraged that when they've deployed our platform as well. So it's not just the box of software. I like to say there's also insights as well. That's exactly the way that they think about incorporating payroll data, right? And I think what the thing that gets them really excited is when you can explain to them how leveraging a traditional mindset of how do we use payroll data, how do we use verification of payroll data in a way that's not like too cutting edge or too aggressive for them. That's what gets them really excited. So if I go back to like the first job that I had out of college, if I may, right, I was at a mortgage bank, right? And in the middle of the mortgage, boom, we're originating loans, but, we would have done a lot more, probably a lot more would have gone bad had it not been for the fact that we had to do a verification of income. And with the verification of income in 2004 was someone at our mortgage bank, which would sell all of its originations. We literally had a few people dialing for dollars. They would call the employer that was stated on the documentation, and they would verify that income, right? That slowed everything down. So if you tell a bank, well, we can actually get rid of this concept verification of income, right? There's no reason in the world why a 1099 worker, a W-2 worker, someone who is documented using a payroll system, you could very easily leverage the RL system to get all that rich data in a very automated way. That's extremely powerful to the bank because it drives high levels of automation, and it's not too aggressive in terms of sort of a modern approach or an aggressive approach. Now, there's obviously always going to be exceptions, but if you say to them, hey, look, this is a great way to, evaluate and add in rigor around the ability to repay, they're going to be happy from a regulatory standpoint. They're going to be happy from a credit risk standpoint. So I think that's where it's really important to understand it's not always how you can be cutting edge. It's how you can actually help the banks advance into the world where they are, driving a lot higher levels of automation, right? They're improving that manufacturing process, like you stated before, Alex. And then the distribution of those products becomes a whole lot easier as well, because the whole end-to-end flow is a whole lot easier. And it's not aggressive, right? It's not black box. The one thing that financial institutions hate the most is that when you can't explain the decision that you're making and how you make it, there's accountability. It's very easy to understand, and the value proposition is extremely obvious. And that's why we've had a great experience leveraging and working Argyle integrated into our process on an end-to-end basis.
One of the challenges, to your point, is that banks are, from a lending manufacturing perspective, they are conservative, right? And that's not just from a risk perspective, it's from a compliance perspective, it's from a brand reputation perspective. But, so much of the value of these things is just, hey, look, it takes you X amount of units of effort to manufacture a loan today. That's silly. That's a loss for you. That's too much work for your customers, right? I mean, I've been through multiple lending experiences where they're like, yeah, we'd love it if you could take copies of the last 6 months of pay stubs and send those, email those to us or put those in our little sort of Dropbox file system that we have. And it's like, are you serious? I mean, I just, that level of work, not only does it kind of destroy your margins in a lot of cases, depending on what type of lending you're doing, but it's just such a negative signal to the customers that you want to attract. So removing that and just automating that makes all the sense in the world. You mentioned compliance and explainability, and Matt, I wanted to ask you about that as well. I mean, you guys obviously work with a lot of sort of lenders, including ones that are kind of conservative by nature. How do you talk to them about the compliance aspect of using this new data source? Because I think the default reaction that you get from a lot of banks is anything new is a compliance risk, just by default. And obviously, that's not necessarily true. There's a lot of nuance there, but how do you sort of have that conversation?
Yeah, it's a conversation we're very familiar with. John, I'm sure you're very familiar with having this conversation with any data source that's, a part of the platform. So before I answer it, I always like to lead off with a disclaimer that this is not legal advice and I am not a lawyer. However,
thank you for saying that. Yes.
I am super, super familiar with this corner of the world because my start in financial technology was direct mail marketing. You really have to understand FICR well to do that well. So, again, going to add a little bit of context to answer the compliance question, right? I think a lot of people by default assume that the credit decision is the entirety or the entire process of the underwriting decision. And that simply is not the case. The credit decision is a very, very important part of underwriting, but by no means is it the only component. I think typical underwriting waterfall from my experience, and John, if you hear anything different, please jump in and let me know. Generally, folks like to run business rules first. So self-reported things like self-reported income. Do you live in a state that I operate in? Are you over the age of majority? So on and so forth. If the consumer doesn't check all of those boxes, they'll just decline for business rules. That way they can manage data costs, right? You don't have to pull credit. You don't have to do bank verification. You don't have to verify income and employment. Mm-hmm. Generally, the second step is the credit decision. And the reason for that is kind of twofold. One, there's no consumer friction, right? So you can generally pull credit in a waterfall, pull it in pieces, manage data costs down. Once you've pulled credit, then you can offer effectively it's a firm offer of credit. That's what you're extending. You're saying, hey, I'll approve you for up to X at a rate that looks like this, assuming that we can verify everything else you told me, right? It is the financial institution's right to go verify other things on that application. And, you're minimizing kind of data costs. You're also minimizing customer friction. The other piece that you're kind of optimizing for by taking that approach is once you've shown the terms, the person may say, hey, you know what? I actually don't want this product. And then you don't have to pull anything else, right? So that's generally why it's done that way. Where Argyle really fits into this process is that last step, right? It's really the verification stage of the underwriting decision, not the credit decision. And you can absolutely, as a financial institution, use consumer permission data to, decision as part of the verification stage. If consumer A says, I make $100,000 a year, you pull credit, you're like, yep, consumer A looks pretty good. And then you verify their income and it turns out they make $25,000. You can say, you know what, that offer that I showed you earlier, we're not comfortable doing that anymore. We're going to decline you. So the conversation is always around breaking that underwriting decision into the requisite components and just making it really, really clear. This is where we fit in. This is how you should be using us. So that is how I generally answer it. John, I know you guys also work with a number of banks that we don't necessarily work with. Is that generally in line with your experience as well?
Yeah, I think that's right. I think that's spot on. And you use the term waterfall. that really echoes with our clients that they understand you can do this in sort of staged environment that actually becomes very cost effective. It actually becomes very experience effective as well, because you don't need to put every customer through every process. But that's exactly right, Matt. We couldn't agree with you more.
Alex, I think you also briefly asked as part of that question, just kind of impact on this data set in terms of fair lending as well versus just necessarily Fair Credit Reporting Act. And so I'll briefly answer that as well. I think in general, and this absolutely applies to Argyle's data set, but really in general, all consumer permission data is going to level the playing field more than it used to be, simply by nature of we're giving financial institutions the ability to verify a metric that formerly would have been cost prohibitive to verify. So calculate if you wanted to include payment to income or debt to income as a component of your risk matrix for, say, I don't know, the riskiest 3 deciles, the only way you could do that reliably historically was either to pay a ton of money for the data, which you're not going to do for smaller ticket loans, or do it by hand, which becomes very, very expensive. To John's point, like in mortgage underwriting, the most common way to do it was to literally call. And today, depending on where we are in the FICO spectrum, the most common way to do it is to say, bring in 2 pay stubs, and then you're paying 2 different people to look at those pay stubs and decide, are they real or not? And so I think by making access to the data a lot easier, what we've really been able to do as far as fair lending goes is say, hey, we're going to verify, if I'm the institution, we're going to verify income on the riskiest 50% of customers. And what that's ultimately going to do is it means I can accurately price them and accurately assign them in my risk matrix based on something beyond only using FICO as a cutoff. So it absolutely adds value there for the consumer. And in terms of producing, I would say, more accurate lending decisions. I always hesitate to say better lending decisions, but I think more accurate because you're able to use more kind of axes in that matrix.
Yeah. Well, and I think, again, I'm not a lawyer either, not legal advice, not a commentary on like the purpose of regulation, but I do think accuracy sits at the bottom of fairness, right? I mean, what we really want is for everyone to get priced for loans in a way that's commensurate with the risk that they actually pose. And so more data is super useful in that way. And I think that, it's funny, one of the examples I always think about, because I was talking with Shmulek on a previous episode about the sort of challenge of building some of this stuff when, a lot of the folks who work in and around fintech live in New York, San Francisco. We have these great white collar jobs and make a lot of money. Like there's a difficulty sometimes in building for consumer segments that really need better lending innovation and need more sort of data and more access to lending, but that are living different lives and have sort of different sets of circumstances. One of the examples that I've always enjoyed that's kind of a very simple one, but it speaks to the need for this type of data and nuances. I was talking to an auto lender and they were saying that the sort of near prime and non-prime customer segment that they serve, one of the questions that they used to ask on their application that they stopped asking was, what's your annual income? And the reason they stopped asking it was that a surprising number of folks would fill in $0 for their annual income, which obviously would trigger all of these problems with the credit decisioning and the workflow and the underwriting. It would lead to all of these sort of confusing interactions. And what they figured out was for a large segment of the consumers that they were underwriting, those consumers are paid hourly, right? Or paid by individual shifts. And so when they were asked, what's your annual income? They said, I don't get paid annually, so 0, right? And obviously that's not what was intended, but it kind of goes back even to the point, Matt, you were making about the lumpiness of someone's income and the sort of nuances that it takes to understand what someone's actual income is. That's not always as straightforward as we might assume when we're designing these applications, just sitting in an office building these underwriting flows.
Couldn't agree more. I can tell you actually, just along those lines, last week, we've been working on, I don't want to say income normalization. I'd more describe it as, great, if your year-to-date salary or year-to-date pay is X, how does that translate to, annual, monthly, semi-monthly, so on and so forth, just to align with pay schedules. And looked at our calculation and then compared it to approximately, 20 pay stubs, and all 20 pay stubs were completely different. So we were able to normalize that behind the scene so that, again, if you think about verifying income on more people or producing a more accurate decision on more people, honestly, it's just impossible to do that without leveraging a programmatic approach. But yeah, that really resonates with me, having just done that by hand.
It's a thing. And I mean, Jonathan, the other thing I wanted to ask you is more on the consumer side, right? Because we've been talking about this more from like a back office automation perspective. But I mean, I know Amount spends a lot of time being very thoughtful on the user experience and the friction that you're imposing on users and like what that process looks like. And a conversation I know has been happening for a while around open banking is, okay, so where can we pull open banking in and like what is the impact on the friction to the customer and asking them to log into their bank account and like what does that look like and when in the process are they willing to do that? Payroll is a little different. It's similar in that we're asking for credentials. We're getting the customer to opt in. It's not like checking a box and giving permission to have your credit file pulled. It's a little bit different. In my conversation with Shmulik, he pointed out actually that a lot of payroll credentials are really more employment credentials these days in terms of like if you work at, Uber or you work at Domino's or whatever, like you probably know your credentials for logging in because that's the system you use to pick up shifts and to manage your hours and to clock in and to clock out. So the credentials are fairly well known, but it is a little bit of a different experience for the consumer. What's been your experience like integrating that into these underwriting experiences and these lending experiences for consumers?
At the end of the day, you said it, right? It's all about friction and flexibility and what making it as easy for the customer as possible. But what I think the open banking concept, the leveraging payroll data concept, everything that we've been talking about here, what that allows the financial institutions to do, and obviously you need the right platform to be able to deploy this, is have that flexibility to weave in a particular component of the experience where you want and where it's most useful, right? So the concept of step-up authentication, and that can be the matrix concept, that can be across risk spectrums, that can be across product sets. We're much more willing to overlook certain things when it comes to smaller balance credit cards that we might be more strict on when it comes to larger balance unsecured installment loans. So I think the ability to, drive that step-up authentication, that friction where friction is needed, helps deliver that optimal customer experience. It improves decisioning outcomes. It prevents fraud, which is obviously a big, topic of conversation. So if I have a 800 FICO, just to use that FICO as an example, 800 FICO customer, everything in the history, all the third-party data checks out, the things that I'm doing on a basic level from a KYC perspective, from a fraud perspective, and a credit risk perspective, hey, maybe I don't want to put that customer through that incremental friction. I most certainly don't want to ask them to upload any PDFs, and that would include a pay stub, which they would then have to go get from their credentials, right? But if I do want to ask someone to upload additional verification, I do want to verify that person's income. This is a borderline decision for whatever reason, right? Without getting into credit policy discussions and what that nitty-gritty might be, I can actually make that tactical decision on the spot to say, well, this is something where I'm going to want to put the customer through that additional friction from an ability to repay standpoint, from a fraud prevention standpoint. If you now can provide me credentials to a employer payroll data, and I can now actually pull the Argyle data, that's doing really two things, right? One, it's telling me that person is who they say they are. It's another data point in that verification process, but then it's also getting me that critical decision, that critical information as part of the credit underwriting decision to make sure that this person has that ability to repay based on the standards that I'm setting forth. So it's really, again, like having that flexibility. That's what the banks are really looking for at this juncture, because what they really understand is that not every customer is the same. And at the opposite ends of the spectrum, you have a fraudster where you want to throw as many things as you can at them to basically make them drop off, because there are still FCRA compliance, FCRA compliance concerns when it comes to suspected fraud. You can't just outright decline someone because you think something's happening.
But you might want to give them a little bit more work, a little more homework to get through.
Exactly.
And
a little bit more friction.
Yeah.
Let them go find, a soft spot to penetrate a different fortress elsewhere, right? To, your best customer where they've SSO'd from their existing online banking. They have a huge relationship with the bank. Why would we want to put them through anything but, hey, you want this credit product? We know you're a good credit. Here it is, right? And you want to have that tailored experience. And it goes back to the original point, which is you want to give customers that Apple and Amazon experience. I know a lot of people are expressing concern about Apple and Amazon coming into banking. That's a whole separate discussion. That's not my concern. My concern is the experience component of it. This is what everyone wants. So if you can actually give them a tailored experience, and it doesn't sound like asking them to provide payroll verification and that login is tailored, but it is, right? Anything that you can then, customize a journey for a customer and make their experience better for who they are and what they're applying for based on their profile, that's going to be a win with the customer every time.
Yeah, absolutely. And, I think as we sort of look forward into, okay, so we have a lot of work in banking to do to just kind of catch up on some of these things, right? Have that Amazon, Apple type experience, modernize a lot of these back-end manufacturing processes that are just deeply inefficient. Matt, to your point, maybe bring more data in and kind of level the playing field and make this fair. The other thing I wanted to ask about, and Matt, maybe I'll direct this to you to start, is where are we going next? And the reason I ask is that anytime we have these sort of unlocks of this new sort of programmatic access to a type of data that we haven't had before, we start in a reasonable place by saying, okay, well, we don't need to look at inquiries for measuring someone's financial stability. We can just actually know what their financial stability is in real time. So let's update that. Let's update our mental model and do this smarter. But the next thing you start to think about is, okay, well, what could we build today? What kind of lending product or experience could we build that maybe we just couldn't do before, right? Like in a world where we only had credit data and it was only updated every 30 days, this was just not feasible. But now that we have this ongoing programmatic access, consumer permission to this data that gives us a really good view into like affordability and income and stability in real time, moment to moment, what can we build around that? I know it's early, but like, what are some interesting examples or sort of lines of thinking that you've seen that you're excited by?
To me, what I'm most excited by is truly matching every consumer with the product that makes sense for that consumer. And we've talked on it or around it a few times. You're thinking about kind of willingness to pay and affordability, right? And it's a component of underwriting that, again, historically, it's been really, really expensive to get that right unless you're doing something like a mortgage because the economics on a mortgage support it. The reason I always focus on that is at least in my mind, the number one kind of trap that a consumer can fall into is overextending by, say, maybe inflating their income a little bit. They think, oh, everything's going smoothly right now. I'm not planning for 6 months from now. I'm planning for right now. I want to take that vacation. So I'm going to open this new credit card or take out a loan, whatever it is. And because historically, the industry hasn't been able to verify income and really look at affordability through that lens, I think we've put consumers in a tricky position where if they do get out over their skis and then they start falling behind, it can become this very vicious cycle where someone who is a very responsible borrower for 10, 15, 20 years just gets a little bit too overextended, has one or two things happen, and suddenly, they end up in a deep subprime space, right? That it's hard to recover from that quickly. And so where I hope we kind of get to, and where, we're already starting to see people think about this, and again, John, you made the point perfectly, tailoring that underwriting experience, not only at the financial institution level, but even at say, like a Credit Karma level, where, it's being shot to a lot of financial institutions. They can all extend, different offers. Being able to truly personalize and tailor that to make sure that everyone is getting the right product. Yes, it's great for credit performance if I'm a lender, but it's also really, really good for consumers because it prevents them from ending up in these kind of really tough positions. So where I hope we end up and where I think we're starting to move is really that. It's being able to match every person to a product that actually fits their need.
Yeah, I love that. I think that makes sense. And I mean, it's the idea that doing something that can improve a lender's credit performance is like, oh, well, that's good for the bank, but who cares? Like, actually, we all should care because better performance for lenders means consumers are taking on credit obligations that they can handle and being able to manage them responsible. So there's a very important other side to that I think is really important to keep in mind. John, I'm going to end the podcast with you along the similar lines of what I just asked Matt. I mean, I'm wondering if you can play a little game in terms of like, if you close your eyes and think like 10, 15 years from now, assume that like payroll connectivity becomes more of this sort of ubiquitous tool in the toolkit for lenders. And, we have this data and like we've sort of accomplished the goal that we're working on right now. What is the market going to look like? What is lending going to look like in that sort of future state? Can you sort of prognosticate for us a little bit?
Yeah, sure. I'll put a little bit of the futurist hat on, and I'm sure, like you said earlier, that'll be totally wrong, because things always go.
John actually has a hat that he's putting on. You guys can't see the video, but he's like grabbed a hat and he's putting it on right now. So yeah, please go ahead.
Yeah. So listen, Chat GPT, right? AI, it's all the hottest rage right now, and it's consuming the discussion that we're having publicly right now. But I think with payroll and other transactional data readily available, when I would expect to be able to integrate all that data into a predictive model and predictive models that help us, with loan, line sizing, product offerings, product tailoring, and account management. And maybe a little bit more of a bold suggestion would be the concept of an active application, an active credit application. Someone reaches the bank, whether that be an in-person channel, whether that be, through a digital channel, that process might actually go away, right? So I think with the sort of tools that might become available, what we know about a customer when they walk into a branch, what we know about a customer when they're transacting online, whether it's on a financial institution's website, whether it's on some kind of e-commerce site, there will be enough intelligence to understand what that individual or business might qualify for from a credit perspective, and we can sort of be proactive in terms of applications. Now, the compliance-minded people in the room or listening to this might be going crazy right now. What do you mean there's not going to be a credit application? Sure, we'll have a checkbox. They'll actively acknowledge and have the right disclosures. Sure, right? But I think the data and the ability to synthesize that data into a predictive model will be likely powerful enough for us to deliver those products much more proactively rather than sit back and wait for a customer to go actively say, I want this, right? Maybe there's never going to be an amount on a credit application again. I'm not asking for $35,000, $50,000. My models will tell me what you qualify for, and that is the offer that I'm going to make. And then with the aggregator channels and everything like that, that's going to be, the analytical arms race to say, where can I make the best credit judgments based on that? And that's how I'm going to win the client by making the biggest offer, the most appropriate offer with the right product structure. So that's, kind of where I think, we could potentially go, leveraging all this rich data that is now, we see how we're using it a little bit more proactively, but how that sort of like takes it to the next level with some of the tools that we see emerging right now in the AI space.
That's a great vision of the future. This idea that we can have contextual streaming credit that's sort of always on, always available, and is based on, and this goes back to what we've been talking about, is based on data that I have opted in to share, right? So I'm completely in control. I've opted in or I've opted out. I'm sharing exactly what I want, and I'm getting access seamlessly to what I need. And I think that brings us to the end of this, which is just that like lending is an enabling product, right? It enables people to get other things that they need. I don't think people want to go out of their way to get loans any more than they have to. So that's an awesome vision for the future. We will leave it there. John, Matt, thank you so much for joining me for this. I learned a ton and really excited for this future that we've been talking about.
Great. Thanks for having me. Really appreciate it.
Thanks so much, Alex.
Thanks for listening to this episode of Fintech Takes. If you want to hear even more insights into the past, present, and future of fintech, be sure to check out The Fintech Factor, the podcast series where I try to figure out how fintech companies can build sustainable differentiation in this golden age of fintech infrastructure.